Good morning, everyone. My name is Shunyi Liang, and today I present my research on financing mechanisms for building contractors in Australia, which is a very good complement to my report. This topic comes from our Bond University subject, Construction Tendering and Finance, under instruction by Dr. Jasper. This study looks at a crucial but often overlooked question: how do Australian contractors actually fund their projects under today's high-risk, low-margin conditions? So while developers and public-private partnerships have well-studied financial models, contractors operate within tighter margins, longer payment cycles, and stricter compliance requirements, especially under Security of Payment Act and Trust Account frameworks here in Australia. My goal today is to unpack the industry's liquidity problem and outline the key financing mechanisms available, and show how different company scales, from small subcontractor to tier 1 builders, can assemble funding combinations that are both affordable and aligned with project cash flows. So, as you can see from figure 1, the number of registered building insolvencies in Western Australia has increased steadily since 2019. Construction contributes around 8 to 9% of Australia's GDP, yet accounts for about 40% of all corporate insolvencies. Margins are extremely thin, typically 2 to 4%, and contractors face long cash conversion cycles between progress claims, approvals, and payments. Even when sometimes a project is profitable on paper, many firms fail because their cash flow inflows simply cannot keep up with outflows. It's not a profit issue, it's a working capital mismatch. Accounting profit may be positive while cash flow is negative. And banks have also shifted their lending preference toward tier 1 companies, leaving small and medium-sized contractors credit-stuffed. On top of that, retention funds and payment delays can tie up to 10 to 15% of contract value. The key takeaway is this: from cash flow to no profit, and it's the lifeblood of construction. Without synchronized financing, project delays multiply, risk premiums rise, and the cost ultimately pass through to home buyers and tenants, worsening housing affordability. The next figure, breaking the vicious cycle, illustrates how financial stress propagates through the sector. When payment delays occur, SMEs experience immediate cash flow friction. To stay afloat, they take on expensive short-term credit or pause operations. That pause becomes a delay for the head contractor and soon for the client. And average financing costs have already risen around 180 basis points since 2022, according to RBA data. And 73% of small builders report payment delays beyond 30 days. And these delays caused insolvencies to cascade across supply chains, pushing contractors into losses and ultimately slowing housing delivery. To break this cycle, the industry needs two things. So the first thing is faster enforcement under the Security of Payment regime. And the second thing is funding tools that match the rhythm of certified progress payments. That's the foundation of the rest of my presentation. How to design financing mechanisms that move in sync with real project cash flows. And security of payments itself doesn't provide funding, but it creates predictability, which is exactly what lenders rely on when approving short-term credit on factoring facilities. Therefore, for decades, most research and policy papers on construction finance have looked at developers and PPP sponsors, how they layer equity, debt, and concession structures. But in reality, the contractor side of the industry faces a completely different financial problem. Short-term working capital pressure, longer payment lags, or even compliance under security of payment and trust account frameworks. Our research fills that gap. We systematically reviewed all accessible and affordable financing tools from a contractor's perspective, comparing cost, speed, collateral, and lender documentation requirements. This focus is just in Australia from 2015 to 2025. Mainly building projects from residential, community, and light industrial, with some comparisons to larger industrial and defense infrastructure. If you look at the chart on the top, you will see construction work volumes continue to grow while the labor and the finance supply lines remain tight. That imbalance between our output and the financing capacity is what makes this topic both timely and essential. Here, I will briefly explain the research structure behind the findings. We'll use a multi-source triangulation method combining quantitative and qualitative data in 4 dimensions. First, under data collection and screening, we gather credible material from government, banking, and academic sources like RBA, ASCI, QPCC, CEFC, and ARENA, covering the period from 2015 to 25. Second, we organize the sources into evidence hierarchy, which means legislation and government reports at the top, following by audit and industry data, bank white papers, reviewed research, and finally, verified material. Third, we coded information along 3 axes. First is funding type, from debt, equity, hybrid, grants, and the second is firm scale, from small, medium to large. And third is lender requirement, ratios, covenants, and documentation, etc. Finally, the 2 comparative tables were produced. One that compares funding mechanisms by cost and accessibility, and another chart maps lender requirements like collateral, LVR, and DSCR. Together, this gives us a structured way to evaluate which financing method best suits a project's cash flow pattern and risk tolerance here in Australia. This flowchart explains how a contractor should structure financing and decisions step by step. The key principle is simple. The loan disbursement rhythm must align with project certified progress rhythm. You must start with the contract type, like lump sum, design build, or cost plus, and forecast your progress claims and retention releases. Then you assess your funding gap, the space between outflows for wages and materials and inflows from progress payments. Next, you screen available mechanisms, debt, equity, hybrid, or grant by cost, speed, and eligibility. Before approaching lenders, prepare all documentations like audited financials, QA certificates, SOP proof, insurance, and PPSR records. These financing decisions sit at different layers of capital structure, from short-term liquidity tools like overdraft and invoice finance to longer-term debt or equity. Approvals and drawdowns should link directly to monthly certification, and you must constantly monitor ratios and covenant triggers. The diagram on the right, based on the Commonwealth Investment Framework, shows a similar logic at the national level. Major projects go through a multi-stage funding gate, moving from proposal to steady state. Contractor can mirror this structured approach internally to improve consistency and lender confidence. So, when approaching lenders, documentation quality is more persuasive than physical collateral. What does that mean? So bank and no bank financiers look for 3 things. credible evidence of repayment, compliance discipline, and transparency of cash flow. They assess collateral through property titles or general security agreements registered on PPSR, and they test leverage ratios such as LVR below 70%, DSCR above 1.25, and 1CR above 2.0. Covenants requires contractors to remain net worth and cash reserve thresholds and to report quarterly. Drawdowns must be tied to certified progress claims. No certificate, no funds, insurance, and guarantees complete the security package. Most red flags come not from poor performance, but from late or missing reports. So good reporting discipline literally reduce borrowing cost. And most important is these covenants mainly apply to structured bank lending or larger syndicated facilities. Smaller tools like overdrafts or invoice finance are usually assessed differently. So this table compares the major financing options available to builders. Senior or construction loans are the cheapest but slowest. They suit suitable stable projects such as AirTrunk data center or defense upgrades. Working capital facilities and overdrafts are fast but expensive, often backed by impersonal guarantees. Specifically, invoice finance gives small contractors liquidity within 48 hours, relying on certified receivables rather than just real estate collateral. Second is equity through joint venture or retained earnings, like add flexibility but dilutes control. And hybrid and mezzanine sits between debt and equity, carrying higher coupons for high risk. Finally, grants and concessional public funding supports innovation and ESG qualified projects. The key message is that optimal funding is not the cheapest. It's the one whose disbursement regime matches the project's payment regime. And remember, each mechanism operates at a different level, and overdrafts and factoring for liquidity, construction loans for project debt, liquidity for capital base, and SPV structure as financing vehicles. So we mentioned a term, SPV. What does it mean? We have to understand core mechanisms. These three financial pillars underpin almost every case we studied. First is SPV, the special purpose vehicle, used in PPPs like the Gold Coast Collateral, illustrates project risks and allow lenders to underwrite those SPV cash flows and instead of sponsor's balance sheet. Second, the loan-to-value ratio measures leverage. If a contractor borrows, for example, $14 million on a $20 million asset, the LVR is 70%. And a lower LVR means a stronger credit and cheaper pricing. It also interacts with DSCR when assessing repayment capacity. Third, factoring or invoice finance. This is a term we often heard. What does it mean? It means a liquidity bridge for SMEs. The contractor aligns certified receivables to a factor, receives 80% upfront, and the balance when the client pays. It's fast and collateral right, but costly. If disputes arise or contracts forbid assignment. Together, SPV secures projects, LPR secure loans, and factoring secure liquidity. Let's move from theory to practice by looking at how financing mechanisms play out in our real Australian projects. First, I'm currently working in a company called GemLife Community Group, just here on the Gold Coast. It's a medium-scale community developer listed on the ASX this year. GemLife runs an integrated model combining equity from joint venture partners with construction loans from commercial banks. and subcontractors are supported through invoice financing and security of payment compliance, ensuring that progress claims are matched by cash flows. The structure balances affordability and liquidity. Trust accounts protects funds, and factoring eliminates cash flow lag. After its IPO this year, in July, GemLife's stronger equity base will let it borrow at even lower cost, demonstrating how public listing improves bankability. Now compared to a data center project, AirTrunk, very famous company, a tier 1 infrastructure case, a $16 billion sustainable finance deal in Asia Pacific largest green data center loan, actually used syndicated senior debt, mezzanine tranches, and also sponsor equity. By meeting CFC and the LEED certification, which is a green building certification standards, AirTrunk qualified for margin discounts of up to 25% basis of points. And this takeaway as a speed and sustainability. They both reporting can coexist when lenders view compliance and reliability as new forms of collateral. In these PPP and infrastructure projects, financing is arranged at the SPV level, but contractors' liquidity still depends on how milestone or availability payments flow down the chain. So, let's see. Public and industrial projects are more use structured finance. For example, the Gold Coast Collateral Stage 3, just finished, illustrates PPP model. Oh, not finished. It's finished next year. Illustrates a PPP model funded through a special purpose vehicle. This SPV pooled capital from federal and state governments, plus private lenders, ring fencing and financial risk, while enabling milestone payments. Because progress payments was state guaranteed, the project achieved low cost debt and clear accountability. It's very interesting. And its governance framework now serves as actually a benchmark for Queensland's future transport or infrastructure PPPs. And the Kwinana waste-to-energy plant in the Western Australia shows the industrial energy version of this model. It combines concessional debt from CFC and ARENA with senior commercial loans and global unity equity. Here's the difference. Predictable waste supply and power offtake contract anchored the cash flow, cutting its weighted average cost of capital. Once the construction was completed, the project itself, I think, will refinanced into a longer tenor green bonds, which is proof that the risk reallocation across the life cycle can lower financing costs. Both cases demonstrate how sustainability and metrics are now integral to lender assessment. Perfect. From these cases, we can generalize a few scale-specific strategies. From micro to small contractors, liquidity is everything. They should complete invoice finance, a small overdraft, and equipment loans registered on the PPSR. What matters most is having variable security of payment certificates and contract clauses that allow receivable assignment that keeps cash moving and prevents credit lockout. For media-tier builders, the success depends on blending construction loans with supply chain finance while maintaining 12 to 18 months rolling cash flow forecasts, monitoring ratios like LVR and DSCR earlier, and registering assets properly on the PPSR, preventing covenant breaches and strengthens leverage with banks. Finally, Tier 1 enterprises, they can orchestrate Syndicated loans and mezzanine layers often linked to ESG pricing benefits. They manage multiple lenders simultaneously and pre-arrange refinancing windows, which gives them flexibility and a cost advantage. Across all scales, the rule is simple. Cash flow, and cash flow. Cash flow alignment matters more than nominal interest rates. The alignment between payment evidence and finance rhythm is the core of financial resilience in construction. Remember this, it's very important. Before talking to any lender, a contractor's strongest negotiation tool is preparation. A complete verifiable package does two things. So it shows approval times and cuts the perceived risk premium, sometimes by a full percentage point. How does that work? So it starts with financial statements, 3 years of audited and management accounts, current work in progress and backlog reports, and tax compliance records. Next is project evidence, awarded letters, contract conditions, progress schedule, superintendent or QS certification, and proof or security of payment and compliance, and so on. Third, collateral and guarantees, like value valuation reports, insurance, performance bonds, director information, PPSR information. Fourth, ESG and safety compliance, including modern slavery and trust account adherence. Finally, a forecast model that runs at least 12 to 24 months ahead with sensitivity tests for material price shocks and payment delays. Showing this level of readiness signals professionalism. It's very important also. Banks will equate that discipline with creditworthiness. So let's move to the next part. This study concludes that what determines the success in contractor finance isn't the nominal interest rate, but how close fund follows the work progress. Three findings summarize this journey. First, different mechanisms play a different roles. Construction loans, invoice finance, and mezzanine layers fill distinct spaces in the capital stack. There is no one-size-fits-all approach. Second, lenders now value evidence over assets. We need clear SOP documentation, transparent trust account data, and compliance record carry more weight than collateral volume. Third is optimal mix shifts by scale, like SMEs rely on invoice finance plus overdraft plus loan plus SCF, and tier 1 firms on syndicated debt with green or ESG-linked pricing. The future lies in standardized progress, payment data, digital SOP platforms, and also open data sharing between regulators and lenders. That's how we lower friction, reduce cost, and make capital genuinely accessible. Remember, financial should follow the flow of work, not the weight of assets. It's useless. Here I've listed the main references underpinning the analysis, from the Western Australia Building and Energy Insolvency Data to Oxford Economics Construction Outlook, and major frameworks by the Commonwealth Department of Finance. Industry and finance sources like PwC's Energy Transition Guide, Forbes coverage of AirTrunk, and government reports from CFC and ARENA were used to validate each project's funding structure. Academic references such as Wang and Li and Zhang and Taizer informed the theoretical framing around financial resilience and especially digitalization. Together, these sources make the study both empirical, grounded, and methodological transparent. Thank you for listening. I'm happy to take questions on any of these mechanisms or cases we've discussed. And if you want to see more content, please check my report. Thank you.